Welcome everyone. With stocks moving into bear market territory and inflation running hot, it's understandable that people close to retirement might be wondering, can I still retire or should I delay? And of course the answer is always going to be unique to your specific circumstances, but generally speaking, of course you can retire during a down market or even a recession, with one important caveat. You have to have a plan, especially to protect against what we call sequence of return risk. That's what we're talking about today. Let's get into it. Now, the best way to explain sequence of return risk is to reference a chart like this of the S&P 500, one of the main benchmark stock indices in the United States. And the S&P 500, you go all the way back to 1957, has actually returned on average 10% per year, including dividends. But that average is highly deceptive because actual year-to-year returns tend to be highly volatile. Now, this concept of sequence of return basically describes the risk of getting unlucky and retiring at a very inopportune time, say at a market peak where the first handful of years of retirement end up being very poor from an investment perspective. This can significantly increase the risk of depleting your savings. Now, to illustrate the risk of sequence of return, I want to give you two separate hypothetical scenarios. So let's just rewind the clock back 25 years. And let's say it's late 1997. You're planning on retiring at the end of the year. And you're going to start with $1 million investment portfolio that's got to last the rest of your life. Well, because your buddy or somebody on CNBC told you that stocks return 10% per year, what you're going to do is just put all of your money in something like the S&P 500 or a fund that tracks it. And in an effort to try to be a little bit conservative in case returns aren't as good going forward, you're just going to you're going to start drawing $60,000 per year, which of course works out to 6% of your beginning portfolio value. So we can model out how that looks. Let's take a look. So in this first hypothetical scenario, for someone retiring at the beginning of 1998, here we are at the end of 2021. Amazingly, this person actually has a higher portfolio value than they began with. We can see there's been a couple big dips. Here's the tech bubble, and here's the global financial crisis and the big long recovery from that. But nonetheless, things have worked out. But I want to give you a second scenario. We're going to just change one thing, the time in which this person retires. They're going to retire 2 years later, January of the year 2000. Wow, take a look at what a difference this makes. And again, we're talking about the exact same scenario. The only difference is timing. So same starting portfolio value, $1 million invested in the S&P 500. The only difference is when we retired. So why such a difference? Well, if we go back to our chart, the first person retired here in 1998, had a couple good years of returns before we reached the dot-com bubble. In scenario 2, unfortunately for this person, they're retiring right at the beginning of a huge market downturn. And the result is, unfortunately, because of the sequence of the returns, 3 consecutive years, which I'll show you in a second, of really negative returns, the result is, despite this person investing in the exact same thing as the first person, they're out of money within about 15 years. Now, here's some actual hard figures to kind of give you the math on this, how this actually works. Again, in scenario 1, our starting value is $1 million, but take a look at this. Here's the S&P 500. This person is going to get some huge returns in those first 2 years. So despite them drawing $60,000 out of their portfolio is actually growing. That puts them in a much better position when the dot-com bubble ultimately busts. Now, this contrasts to person 2, who starts with $1 million in year 1 in the beginning of 2000. But unfortunately for them, they're drawing $60,000 out, plus they're losing over 9% on their portfolio. And this happens in the first 3 years of retirement, and you can see what happens to their portfolio value it goes down, it declines to a point where it just never has a chance to recover. It partially recovers here, but then of course the global financial crisis comes, and the end result is they depleted the retirement savings. So this is a textbook example, even though it's hypothetical, of the sequence of returns risk. The timing, in other words, can really matter, and you have to therefore have a strategy to manage against, retiring right at the onset of a period of tougher market conditions. So what's the solution for protecting against this? Well, there's a lot of different strategies, and when I'm working with retirees, which is my professional focus, by the way, and if you found this helpful and you want to have a conversation, no cost, no obligation, please feel free to reach out. That's what we're here to do. But I just want to touch on this real briefly. One approach that we use commonly, and I did an entire video on this recently. I'll try to link to that, but in short, let me just try to be brief. Here's an example that I used to describe what's known as a bucketing approach. The simplest way to understand this is thinking about splitting up your portfolio into buckets, a short-term bucket, a medium-term bucket, and a long-term bucket. And long story short, we want to have what I would describe as a war chest of safe money in this short-term bucket, which can even kind of bleed into this medium-term bucket. So think of cash, money market CDs, perhaps even some government bonds and so forth. And out here in this long-term bucket, this is where we want to have those riskier assets like stocks, but we want to position this so the dollars in this bucket we don't plan on utilizing for, say, up to 10 plus years. And the whole purpose of doing this is we know stocks are going to be volatile, and other assets, even real estate, can fall in this long-term bucket. And therefore, we always want to make sure that we have this big pile of safe money down here that we can spend down in the near term. So in the short run, if we get unlucky with our timing, we retire and stocks go south, well, it's not going to really matter, because we're going to have this, again, this war chest of safe money that's going to bridge us through until returns ultimately recover. So that is, in essence, a bucketing approach, and is one strategy for dealing with the sequence of return risk that exists for all retirees. So, can you retire during a bear market? Well, the answer is a qualified yes. You have to have a plan or a strategy to deal with what we refer to as sequence of return risk. This is fundamentally what retirement planning is all about. Obviously, if stocks just went straight up all the time, you wouldn't need much strategy at all. You could just set your portfolio and kind of forget about it. But that obviously isn't the case. You need a strategy, whether it's a bucketing approach like we described or something else, to mitigate this risk. It is retirement planning 101. But hey, anyway, I want to just say thanks for watching today. If you enjoyed the video, do me a favor, hit the thumbs up button. It really helps get the message out. Thanks for watching, and I hope we'll see you in the next one.